Right, lads and ladies, today we are going to jump into order blocks and mastering order blocks, breaker blocks, mitigation blocks. So, what is an order block? An order block are areas where large institutional traders place their trades. They represent zones where a significant amount of buying and selling occurred, often halting or reversing price movements. These blocks are used to understand where future price movement may return to find support or resistance. Essentially, it's just in a bullish scenario, it's your last down close or couple of consecutive down close candles before a sharp move up that breaks structure. And then you have your bearish order block. It's just your consecutive or your single up candle, last up candle before a sharp move down that breaks structure. Now, a question that some people might have is, does an order block have to sweep liquidity? Technically, it doesn't have to sweep liquidity. However, when it does sweep liquidity, it's a stronger confluence. It's the stronger order block, so to speak. And then important note, these candles must be consecutive candles or the last single down candle. It can't be two red candles, a green candle, and then a red candle, and then it won't be the whole two red candles, it'll be the last one before it. Now here's an example of a bullish and a bearish order block. Last down candle before a sharp move up that breaks structure. Last up candle before a sharp move down that breaks structure. Right, I'm just gonna run through what they all are, what all the blocks are, and then we can run through examples on the trading view. So what is a breaker block? Essentially, a breaker block is an order block that initially failed, but later acts as a stronger support or resistance zone after a market structure shift. It occurs when price breaks through the block in one direction, failing to hold, and then retraces respecting the same level from the opposite direction and reverses rows. Where the block becomes a point of interest for institutional traders, it signals a potential trend reversal or continuation. Their liquidity grab. Breaker blocks are um, breaker blocks often indicate a change in market sentiment, so just a reversal. So here would be an example of your order block. Perfect. So what is an order block? It's your last up candle before a sharp move down. So we can see we swept liquidity here to the left. It's your last up candle that swept liquidity before a sharp move down, sweeping this low or breaking structure. And then what do? Price very quickly reverses back up through this order block. So it's no longer an order block. Now it's a breaker block. Why? Because you've broken through it. We haven't got the reaction of it the way you wanted to. So we broke through it. And now price is saying, right, well, this order block is no longer valid. We're the breaking through it. It's now a breaker block. And we're going to use it and retest it as a level, in this case, support. And then when you have a breaker block with an overlapping fair value gap, well, there's a beautiful trade to take. That's what a bullish breaker block looks like, and then bearish would just be the opposite side. And then you have a mitigation block. So I'm going to show you a real life example in the chart as well to help you understand, because mitigation blocks, you don't have to know them as much as you do with order blocks and breaker blocks. Just know what they are. So mitigation is just the concept of institutional traders returning to previously unfilled orders, such as in an order block, to mitigate their exposure. This often results in price revisiting an order block to allow institutions to exit or add to their positions. All mitigation means is to lessen or reduce the severity of. So if I'm going to show you now, for example, what institutions would do is they buy up orders so they can get a better price for their sell. So would you agree that if I was buying around this level, I would like to buy, then I only get to stand to gain the profit from here down to this low. But if I buy price up, that means I can get it at a higher price and sell it at a better price. You're selling it at a premium then. So you're selling it at a better price, so you stand to gain more from the same movement. However, these buy orders that you put in, they're going to be in drawdown. So how do you fix that? You go back. Banks don't lose; they never lose money. So when they do, they lose very little money. So what do? We come back up and we mitigate our losses. We reduce the severity or lessen the severity of our losses, or even in the case of a breaker block, bang, bang, we're still in profit. So we've taken profit from these sales, and the boys that we were in drawdown for down here, now they're back in profit. I'm going to run through real life examples and then we'll run into mitigation blocks because they can get a bit tricky. Right, what's our pair for the day? No XAU in there. Oh, you were USD. Oh, it's beautiful. Forever. Excuse me. I see. I want to find. There's an order block there. I'd like to find the clear one though for a better example. Here we go. So here is your order block. Why is that your order block? Because these are the last up candles. These candles are the last consecutive up candles that swept these highs, this liquidity here, before we got a sharp move down that broke structure. So this right here is an institutional move for institutions. Instead of selling down here, they bought price up and then they sold up here and then they took advantage of this extra bit of move. But when we're looking at order blocks, actually very important. When we're looking at order blocks, it's important to note that if an order block is, how do we say it? Well, let's say, for example, here's a perfect example. Say this is your order block. This is your last consecutive up candles before price broke down and broke structure and then broke, swept there down there as well. So when institutions are placing orders, what they'll do is they'll buy, they have to buy to sell, they have to generate liquidity, they have to make people think that price is going up so that they can sell. So if, say for example, an institution wanted to buy or sell 10 million lots of Euro USD, or what that means that somebody has to be willing to buy 10 million lots of Euro USD. So what that means, there needs to be 10 million lots of buy orders in the market so they can take their 10 million lot sell orders. So how do they do that? They'll generate liquidity. So how they do that is they'll put in a load of buy orders here, big buy orders, big lot, 80k, 100k lots. We are risking 100k or a million quid a pip per pip movement. So what they'll do is they'll buy price up, and then what retail traders will do is they'll see this move and they'll say, oh, price is going to go up. So they'll continue to buy and then they'll keep going up. So although the institutions only bought in maybe here, and then price drove the rest of the way up through retail traders, through just momentum, but the orders are only here. It's important that we note that the orders are only from the institutions are only here. So when we're looking for an order block to be retraced into, we don't expect it to come all the way back up and fill the order block. Why? Because that's not where the orders were placed. So if we effectively, if we bought in, say we're the banks, what are we going to do? We're going to place a load of buy orders here. So I'm going to drive the price up. Why? Because yeah, it's all good and well that we can sell here. We can sell at this price here and hold it to this low. But wouldn't it be so much better and so much more beneficial if we could just generate liquidity, drive the price up, and then when the price is up here, well, then look at all this more, this movement that we can catch if we drive price up deliberately and then wait until we get up here and then sell from up here. Okay, that means that these positions are going to be in a drawdown. That means that these positions are going to be in a drawdown, these buy positions. So these buy positions that caused price to rally up higher and caused retail traders to buy in and buy in and buy in. And when you're buying in, what are you going to do? You're going to buy and you're going to buy in. Right, well, this move is at the going up, and right, well, I'm going to target whatever. There might be something to the left there, whatever you might be targeting, whatever it is to the left, and you're going to have your stop loss down here. Brilliant. There's their orders. You're at the buying into the market, so they need to sell into the market. You're just at the generating liquidity because now all your stop losses from your entries, they're all going to be beneath the recent low. And if they're not beneath that one, they're going to be beneath this one. They're going to be beneath one of them. So that liquidity is out there being generated, and the institutions are now out there buying up the orders, and then up here they're out there getting into a major sell, and then they're at the capitalizing on all this, and then what are they going to do? They're going to bring price back up, and then all these orders that they filled themselves, so not the top orders, all these orders that are down here, but they're all going to be mitigated. So they're all going to be taken out. So they're all going to be closed, sorry, at either a break even or with a small profit. So when you're looking at an order block, you don't necessarily want to look at, always take your always take your entry between the 50 and the open. Between the open and the 50%. Why? Because if you don't, you stand missing out on the trade altogether. And you can see here a perfect example that we only came up and we came down, and then we only came up, tapped back into not even the 50% of it, and then major rally back down in the intended direction to sweep the rest of it. Because anybody that would have been buying on the way up, stop loss. No, that's not locked. Anybody that would have been buying on the way up, stop loss there, stop loss there, stop loss there, and it's going to be the same in a bearish scenario. So when you're taking into account for order block, you want to take into account especially when it sweeps liquidity, you want to take into account just the 50% and the open, because that's where the orders are actually going to be filled, and that's where the orders need to be mitigated. So that's where you need to be focused on. So now let's say, for example, we already had a bearish bullish scenario. Let's go bearish. You could use that. We'll use that. Here we have actually a good example of both. Last down close candles before a sharp move up. Last down close candles before a sharp move up. Why is this your order block? Because these are the last down red close candles, and I will get into these two candles now in a minute, just before you get confused. These are the last down close, the noise out window, man. The last down close candles before a sharp move up that broke structure. So we came down high, low, lower low, and then we broke past this high, and that's your market structure shift. That's your break. That's when you can say that this was a valid order block. Why can we say it's a valid order block? Because we swept this liquidity and this liquidity and this liquidity and got a deep tap into this fair value gap. So you can say that's a valid order block. So if you can say that's a valid order block, well, then what do you expect the price to do after it does its move? Bang, handy. You'd expect it to come back. Why? Because any institutions that were trading, and don't think, oh, that's a few days, they're not going to hold it. They'll hold it. They'll hold it. I promise you, they'll hold it. They're always going to have a trade. Say, for example, you were selling, and that's all their sell orders. All right, so if that's all their sell orders now, and their sell orders are only between the open and the 50%, why? Because when they place the sell orders, that sells a load of selling pressure into the market, which naturally drives the price down. And then you see people will say, you get a different type of trader then altogether, and they'll say, oh, well, we broke below this low, so we're going to keep going down, and we're going to target this level of liquidity, or whatever they may think. But reason I say that is because vice versa now, if you're selling at the break of this and you have your stop loss, if you're selling at that breakout traders, they'll see that and they'll say, right, well, I'm going to put me stop above this high, and I'm going to put me take profit targeting whatever it may be, this low. Handy, lovely, handy 1 to 1.3 trade. What is that though? What are these? What's this stop loss? That stop loss, they sold into the market. So this is a buy order. So when that stop loss gets hit, it then flows more into more buying pressure into the market, which then naturally causes the pressure to the price to go up again. So you have people who will see this order block and they won't know what it is. They'll see the break, they'll say, right, well, I'm going to sell, and their stop losses are going to get wiped out. But then you have the people who have from here, well, I'm going to buy, their stop losses are going to get wiped out. But then you have the traders, the institutions that know what they're doing, they're gonna wait. They're gonna wait for these, or not wait. They're gonna make them get stopped out. They're gonna induce them. It's called. They're gonna induce them to place their orders here, put their stop loss in a certain spot, and then rally through the stop losses. Stop hunt. But sorry, get back on track here now. These orders keep rambling on. These orders here, they come back. They get mitigated here. How do we know? Because it's between the open and the 50% of the order block. Bang, mitigated. So any sales that would have been in drawdown, because they'll bear in mind these sales are all going to be in drawdown because the prices are rallying up. So although the bank sold here, they would have bought a load of positions down here and then rallied price up. And then as price rallied up, these sales that they're in, they're still in drawdown. So what do they have to do? Come back, let price do its thing, come back, mitigate their losses. That's the whole point of an order block. Now let's see if we can see. Just use this one because it's handy. It's not the cleanest, but it's handy. Last down close candle before a sharp move down that breaks structure. We agree. Last down close candle for sharp, sorry, last up close candle before a sharp move down that breaks your structure. Your structure will be bang. What does price do? Notice how we didn't sweep liquidity on this particular order block. You didn't sweep any liquidity. And notice that order blocks are fractal. They are fractal. They're across all time frames. So although this is a 4 hour, you'll see them on a 1 hour, on a 15 minute, on a 5 minute, on a 15 second. You'll see them on everything. What does price do though? Instead of getting the reaction that you want off of this zone, price comes down and breaks through the zone. Breaker block. Price comes down, breaks through the zone, and then gets a reaction off it. It's just an example because it was there, and every time I go back, the screen just takes ages to load. So in the end, we didn't get the reaction. Realistically, you want price for a valid order block. You want the order block, bang, 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 break through, get a reaction. Use this as your, instead of getting a reaction to the downside, you're going to use this now as your floor, so to speak, and then keep going up. Like I said, I just use this as an example because it was there, it was handy. And now the difference between an order block and a breaker block, stick with me, is a breaker block and a mitigation block is the way the break occurs. So if we look at this chart here, we have a mitigation block. All it is an immature breaker block. So it's just a breaker block that didn't sweep liquidity. So if we look at this diagram on the left, we have do we have a definition here? This type forms running uptrend and is, look at that. Just thought I'll leave the link down below as always. We have the last down close candle before a sharp move up that breaks structure, and then price comes back down, retests this what was an order block, but we broke through, so now it's a breaker block, and then get a reaction off it to the downside or a reversal. And now the only difference between a mitigation block, please don't dwell on it too much, don't think about it too much. It's not important enough that you have to think about it, that you have to, it's just good that you know. I just want to tell you about it. And don't go looking for, oh, that's a mitigate, because you'll only get confused. You don't really need to know. Order blocks and breaker blocks are the most important. Know what a mitigation block is, don't dwell too much on it. Higher high, higher low, higher high, higher low. We never broke. With a breaker block, we broke structure, which one validates this order block, and two, it tells us that we got to sweep liquidity up here as well. But this, there's no sweep. There's no sweep of the high, which shows its weakness in the market one. So you can kind of estimate the price is going to come back down. This will be a CHOC, change of character, where price was continuously making higher highs and higher lows. You'll see in the market structure video. Price is currently making higher highs and higher lows, and then happy days at the bullish trend. But price in this case made a higher high, a higher low, a higher high, a higher low, and then a lower high. This is your change of character because it didn't make a higher high. And then price comes down, and then price comes back into the breaker block, so to speak, and then we get a reaction of it. The only difference is it's a trap. The way the mitigation works is people who are buying from this zone and they see this, oh, where they're breaking through this zone now, they're looking to get out of their buy orders. Why? Because they're in drawdown. They bought in, say down here, or they bought in probably a little bit higher than the order block, and they thought price lovely, we're going to continue this bullish trend that we're in, we're going to break the high, happy days. But we didn't get that. So anybody in buys now, they're trapped. They're trapped because now they're in sales and they're all in drawdown. So what do? They say, right, well, I'm after identifying this change of character. I know that we're no longer the bullish trend. We're just sweeping this liquidity down here. And if you were buying here, realistically, you had your stop loss beneath the previous low, which would be this one or this one. Either way, you're getting stopped out. But if you didn't get stopped out, what you would want to do, what banks do, what traders do, what everybody does, is they want to get out of that. They want to mitigate their losses and get out of that trade altogether. So what they'll do is they'll let price come back up to their entry zone, and then they'll get a reaction off that way. That's a bearish scenario. This is just a bullish scenario. Exact same thing. Boom, boom, boom. This is your mitigation block on the left now. So this on the left is your breaker block up here, but on the left down here, it's your mitigation block. So just don't get confused. If you're looking at it, they're not the same. They're swapped over. A price comes down and we failed to break this high. Sorry, we go with the breaker block first. Price came down and we broke this high, happy days. And then what does price do? It comes back down, a market structure shift because you broke past this previous high. And then we break through, get a retest out of the breaker block, what was once the order block, and then get a reaction off it. Happy days. That's pretty simple to understand. I just want to get through the mitigation block into your heads. With the mitigation, we just failed to get a sweep on liquidity, which shows us that there's more buying pressure in this case than there is selling pressure. So sellers couldn't drive the price down enough to sweep this low. So what they did was, or not what they did, essentially what happened was price came back up. Then we got our market structure shift without sweeping liquidity. So anybody who was selling from this zone with their stops above this high, they're at to getting either stopped out already or else they're in drawdown and they're waiting for price to come back so they can mitigate their losses, and live to trade another day. So yeah, that's just, a breaker block. Mitigation block. Bang. High, low, failed to break the high, came through, and then you'll be dusting around here for a while and your trades are negative. And then once you get the chance to break out at break even, happy days, you're going to exit out your trade. Think of mitigation as a trap for traders, for uneducated traders. I think that's it. I'm going to leave this now. This is a pretty lengthy enough video, so I'm going to leave it there. Any questions, as always, fire away, reach out, ask the question. If you don't ask the question, somebody else probably does have the question and they're just too afraid to ask themselves. But yeah, that's been order blocks. The order blocks and fair value gaps, when they work hand in hand, when you have an order block and a fair value gap at the same time, it's always more, what's the word I'm looking for? It's just always more profitable. It's always more compliments. One compliments, two compliments is better than one compliments. Simple as that. Yeah, so that's been order blocks. I'll leave you with that, and I will see you in the next video.